Profits at German carmaker Porsche plunged by nearly 96% in the first 9 months of this year. Porsche said the drop in profits was due to a change in strategy as the company shifted its focus back to combustion engines after weak demand for its electric vehicles.
After years of roaring down the Autobahn, a speed bump for Porsche. The iconic sports car maker notched up a spectacular third-quarter loss of almost €1 billion as it grappled with the costs of returning to petrol and delaying its electric vehicle rollout. Operating profit, which strips out some costs such as tax, fell to €40 million for the first 9 months of the year. Porsche revved up its electric vehicle strategy with the launch of its electric car project, Mission R.
This concept embodies everything that Porsche, what it is: performance, design, and sustainability. All electric, high performance, and efficient. This is a new Mission R.
Then in September, Porsche went into reverse. The sports car maker said it would delay the introduction of some fully electric cars and extend the life of some combustion engine and hybrid models. The reason was lack of growth in demand for high-performance electric vehicles. And there were significant costs associated with the original, aggressive EV strategy. Porsche's parent company Volkswagen said it had taken a punishing €5 billion profit hit to cover the costs of Porsche's product rejig. Porsche is wrestling with a severe slump in top market China, where the collapse of the luxury market has hit demand and local manufacturers are raising their game. In the first 9 months of the year, Porsche sold just under 32,200 cars in China, down around a quarter on a year earlier. Porsche is particularly vulnerable to Donald Trump's tariffs, as it has no manufacturing footprint in the United States. Porsche may be forced to set up a factory there. In a bid to fix things, Porsche has appointed ex-McLaren boss Michael Leiters as the next CEO. He'll take the wheel in January, hoping to revive demand in China and resolve the EV conundrum. Investors remain to be convinced.
I'm joined now in the studio by Steven Beardsley of DW Business. Steven, thanks for joining us here in the studio. So a big loss in profits, but sales and turnover only dipped by about 6%, with more than 200,000 vehicles being delivered. So what exactly is the problem here?
Yeah, Michael, I think that piece actually covered a lot of good ground. The one point that we have to look at here, actually there are two. Let's first look at what is selling. You're right, the actual sales dipped only a little bit, but it's not the top-end, high-performance vehicles that presumably bring in the highest margins. That is, they make the most money per car compared to other vehicles. So the vehicles that are selling especially well tend to be those where the margins are a little bit lower. So Porsche always wants to maximize sales of that top-end product. That's one of the problems. But the bigger problems, why we've seen this massive hit, is really because of these costs, these special costs, because of restructuring, because of what Porsche is calling its strategy shift. And again, in September, it already warned that this was coming, which is why investors are not going to be so dramatically surprised by what they're seeing right now. There were signs that this was coming. But it is a massive hit. 3.1 billion euros in 2025 is what it's eating because of this decision to go back to more combustion engines, to sort of shift out the electric push a bit further down the line and try and gin up that kind of excitement that they were before. It also shelved that battery manufacturing facility. That ate a lot of money up. And then, of course, the tariffs on top of it. That's not as big as some of those other costs, but you can't overlook that. It's actually quite big.
So, as you mentioned, Porsche wants to now manufacture more combustion engine cars and hybrids. It scrapped its plans to make its own batteries. It's 2025. I thought that the future was EV. So what exactly is going on here?
Michael, it's 2025, which means that the future is no longer, or the future has been postponed, right? So that's what it is that car makers see the market going like this. It's diverging. In China, there is this incredible hunger for EVs. The problem is that the luxury end for Porsche, they're not buying those top-end EVs, right? And the luxury market in general is suffering in China. But what you see is markets that are excited about EVs, and you see markets that aren't excited about EVs. And so the modern car maker has to try and produce for both. And in Europe, because there is a requirement to make only EV vehicles, new vehicles, by 2035, they have to push faster than producers in other markets. And what they're saying here is, whoa, slow down. It just doesn't make sense. And Porsche was really one of the first in the EU to say, we're not going to do it. We're not going to hit this 2035 target that the EU has for all new sales being electric vehicles. We have to sell what actually makes money for us. But they're not alone. You're seeing this happen from everyone else, and the German government is now supporting this push, which we're going to see next year, a decision on to really slow that date of 2035 for a fully electric new car suite in Europe. It's changing.
You know, for decades, the automotive industry was the backbone of the German economy. Is there something symptomatic in Porsche's failure here?
Porsche is one example of many, and you can see that across the landscape here in Germany. In a one-year period that ended in spring of 2025, I believe, you saw 50,000 job losses in this industry. That led all other industries, all other categories of jobs in Germany. So you see how serious the issue is here. Sales are down. Competition from China is up. And you have a lot of expenses involved in investment for meeting these EU goals. All of this comes together, and it means that they have to cut costs fast. And they're doing that by cutting jobs in some cases. And there are more job cuts coming. You see the effects of this already. Go to the auto cities in Germany. Go to Ingolstadt, where Audi is made. And you're going to see that they have a huge budget gap. How are they going to make up for that? They're going to have to curb services. Go to Friedrichshafen. That's a city that has benefited from its relationship with a major auto parts supplier, ZF Friedrichshafen. And they're now receiving less money, so they're cutting services as well. So you are seeing it reach into the pockets of normal Germans. This is a major crisis.
Steven Beardsley of DW Business, many thanks as always. There is no substitute.